Hello, everybody. Gbenga Olatunji here, welcoming you to corporate reporting today from GJAMES Associate Channel, looking at IAS 24. We've started IAS series now. We've treated IAS 34 and now we are on IAS 24, looking at related party transaction and related party disclosure. And when we are talking about related party disclosure, what and what are expected of us to learn? We will be looking at the definition of the IAS, broad definition of related party transaction. We are going to discuss the objective of this particular International Accounting Standard 24. Why do we have IAS 24? What impacts is related party disclosure and transaction making on our financial statements? And you can guess right now, that's one of the main objectives of related party disclosure IAS 24. Then we are going to look at the disclosure requirements and what are the exceptions to the rule of IAS 24. So let us go in without wasting time. IAS 24. There is a long list of relationships that could warrant related party transaction to have taken place. Among them, we've listed a few of them. When we have a party that controls another entity or has a controlling share, so transaction between them will amount to related party transaction. When one has significant influence over another entity, then we are talking about related party transaction there, and we are going to major more on this second point that we just made. When we have joint control over an entity, the controllers has have rather related party transaction relationship or may arise between the three of the parties. The party are under common control. So when we have an organization at the apex having some other subsidiaries and associates under its common control, related party transaction will take place and we will need to disclose it. When the party is a joint venture in which the entity is a venturer, when we have a joint venture and the joint venturer could influence the joint venture, the joint venture may have related party transaction at hand. There may be exception to this rule. As we continue, we are going to learn about it. When the party is a member of the key management personnel of the entity or its parents, that's in form of a directorship. When we have a director manning two or more organizations, there could be influence from that person and the companies will need to be scrutinized against or for related party transaction because of that relationship. When we have a close family member in any organization that has influence over another organization, then we may have a related party issue at hand to be disclosed. We will all agree that a parent company is related and will definitely have related party transaction with subsidiary and associates. So that seems basic. These and many more are the lists of IS 24 in defining what related party transaction is and how they can come into existence. So examples of related party transaction: when we have a sales of goods between aforementioned organizations, we have a disclosure matter at hand. When we purchase property, maybe on or behalf of from related party organization. When we render services to them or sold good, lease between us is a related party transaction that must be disclosed. Transfer of research and development, R&D, when we begin to apply R&D that do not fund because of the relationship with the researcher, we may need to disclose it. Finance arrangements, maybe a form of loan, equity contribution to the other organization, probably junior organization, maybe an associate or subsidiary. When we have such, we need to disclose them. Provision of guarantee to stand in on their behalf, then we may need to disclose, because we can't just ordinarily stand for who we do not know to take a loan or guarantee anything in whatsoever form, shapes, or like. So it's a disclosure transaction. Settlement of liability on behalf of an entity. You can't pay for somebody you do not have relationship with. So therefore, when such occurs, we know that IAS 24 is catching up on us, and we need to disclose what are the exceptions to the rule, especially those aforementioned relationships that we spoke of. What are some of the rules? And if you remember, I said that we are going to come back to point 2 that I made about influence. So influence is very important, and the legal form, maybe the percentage of ownership and the like, in which we can discover and determine who an associate is, who is a who joint venture is, even though it has another legal form and the like. But that is not the only thing that could influence or that could cause a transaction, third party transaction, to take place. Rather, influence actually could make it, and it could be influenced within, without. So it will be narrow when we want to use the legal form alone. We must use the substance of the transaction. Substance of the transaction is a major exception, first of all, before we go into other exceptions that we are going to discuss. Influence, influence, influence. We cannot but understand that influence will affect, just like the legal form could affect. In considering each possible related party relationship, the entity must look to the substance of the arrangement among them, and not merely its legal form. Like I said, although two entities that have the same individual on their board of directors will not meet any of the above conditions of a related party transaction, because the person is just an individual doing his job. But influence could make that organization fall prey because of that person manning two organizations on their boards. A related party relationship will nevertheless exist if influence can be shown. Do we get it? So ordinarily the person is doing his job, but nevertheless he or she can use influence to get something that ordinarily would not have been like that, that is not at arm's length. So because of this, we cannot overlook it. It's possible. So we need to look for influence. If being there of that person has influenced transaction. So what are the other examples of exceptions? Two venturers that simply are joint control or controller over a joint venture. And I think here I should try and define what a joint is. A joint venture, organizations usually come together on a joint venture just to carry on. The joint venturers just have a common interest on execution of a project that they both know that they have various advantages. I'm talking of business advantages that when they come together, they can easily assess and execute their project and make their profits. And after that, the joint venture automatically will be dissolved. So that is what a joint venture is. So that we come together to quickly do a project and everybody part way does not make us to become one or having control over one over the other, even though it may, just like any relationship among two or more people can go, cannot really be predicted. But nevertheless, on the natural side of things about joint venture, is an exception to related party transaction because they are not actually related. Everybody just bring their strength to achieve a purpose and everybody parts way. Provider of finance, your banker, finance institution, that you bank with somebody, with an organization, financial institution does not make them to be related party to you. Trade unions, public utilities. Everybody knows that public utilities belong to the government. So that you use public utility does not make it have influence over you unless it's proven otherwise. Government departments and agencies, you pay your tax, that will not make you to have transacted as a have third party transaction, related party transaction rather, with the government agency. Your customer, you must sell to somebody, you must buy from somebody, franchisor, even franchisee, distributor, and other agents to whom the entity transacts a significant volume of transaction. We must transact unless influences are proven on this side of relationships. On the natural side of things, they are not actually third party related transaction unless proven otherwise. They could be proven otherwise. So it's not cast in stone, please. But we need to understand the exceptions to the rule. What are the disclosures requirements that IAS 24 demands from us? The name of the entity, especially the parent organization. Don't forget, these are natural related party transaction that we are talking about. So we will have a parent organization that we transact with, must be disclosed, and if we have relationships that are more complex than what we can easily trace, we must disclose by way of note also who the ultimate controller is and how they can influence and have been influencing and the transaction conducted during the year under review. where the transactions have taken place between the related party, irrespective of whether a price was charged or not. The following should be disclosed: the nature of our relationship with the people we transacted with. We want to know. We want to know the amount of the transaction. We want to know the terms and conditions so that we can compare it with our normal policy of transacting. Any guarantee given or received as we transacted. We want to know. We want to know if there are any provision for bad debts or recoverable debts on those transactions that we've transacted with those mentioned names. And of course, you could predict it if we should have doubtful or irrecoverable debts concerning third party, related party transaction. What that means to the financial. You will have expenses, recognized one in the period in respect of irrecoverable debts due from related party. We need to disclose it. We need to disclose if we have associates, we have subsidiaries, joint venture in which the entities are venturer. We need to, even though that may be an exception, but if influence is proven, then they will fall under the purview of IAS 24. Key management personnel should, in case influence could be traced because of them sitting on the board of related organizations. Also, just as we mentioned key management personnel, IAS 24 requires from us to make known compensation of key management personnel. And when we are talking about this, we need to disclose both the short and the long employee benefit provisions that we have for them, terminal benefits, and if we have arrangement for share-based payments, maybe as a clause in their directorship consent letter or in any form like appointment letter. We need to disclose this. So should, in case in the exams you are asked to list some of the disclosure requirements, you know what and what to put down now. Next time on corporate reporting, we'll be looking at operating segments. Another important IFRS 8 on operating segments. There and then we'll be talking about reportable segment. We'll be talking about aggregation of segments and the like. Lest I forget, the objective of IAS 24, related party disclosure. The objective of IAS 24 is to ensure disclosure, full information as to the presence of related parties and related party transactions so that the financial statement will not be misinterpreted or conceal important facts. From GJAMES Associate Channel, we would love that you subscribe to the channel. So if you're a first timer on this channel, we recognize you. Please go and subscribe. Yeah. And if you are returning but yet to subscribe, please do so. Click notification, click all so that when we upload new videos, you will be notified on time. And share to other people, share to other platforms so that people that need to hear and have advantage of this channel will be able to be reached and reached through you. From GJAMES YouTube channel, Gbenga Olatunji will be signing off. We have value to life. We have value to your business.